Welcome to week 5 tutorial. Before we begin with this week's tutorial concept, let's review what we have covered in the last few weeks. In week 3, we developed the model of demand and supply. And in week 4, we discussed the concept of elasticity, the sensitivity of quantity demanded and quantity supplied to changes in economic variables. In week 5, we will focus on the impact of government policies on competitive markets using the tools of demand and supply. We know that economists play two roles. In week 3 and 4, we acted as scientists because we built a model of demand and supply to describe the world as it is. In week 5, we will act as policy advisors and analyze how government policies affect the market outcome. We address two policies: price controls and taxes. The method of price control is price ceiling. It is a legal maximum on the price at which a good can be sold. Government wishes to support or to help the buyers implements price ceiling. It has got two effects. We know that buyers like low price. Let us look at the diagram 1, which in economics we call it as not binding. Buyers' demand curve shows that buyers like low price, and suppose the price is at the bottom of the demand curve. Price increases. It gradually rises to point of equilibrium, and we notice that the price balances supply and demand is below the ceiling, which is not binding. Market forces move up to the equilibrium and the price ceiling has no effect. On the other hand, in diagram 2, let's consider a very different picture. We will again go to buyer's demand curve and we will rise up the demand curve. Prices are rising, and as it touches the ceiling, it cannot go beyond it. It's a legal binding because equilibrium price is above the ceiling is a binding constraint to the market. The forces of supply and demand tend to move the price towards the equilibrium price. But when market price hits the ceiling, it can rise no further. It is a legal constraint, a legal binding. Thus, the market price equals the price ceiling. At this price, quantity demanded is greater than quantity supplied. This creates a problem of shortage. This policy was supposed to help buyers, but not all buyers are able to get what they want. The second method of price control is price floor, which is a legal minimum on the price at which a good can be sold. This policy is implemented when the government wants to support the sellers. It also has got two outcomes. Let's look at diagram 1, which we call it as not binding. We all know sellers like high price. And let's now look at the supply curve from the high price when the price starts falling down. When it starts falling down and as it hits the equilibrium price, it does not fall much further because both buyers and sellers are happy at the equilibrium point. Because equilibrium price is above the floor, the price floor is not binding. Market forces move to the equilibrium and the price floor has no effect. Just on the other hand, look at diagram 2. It has got just the opposite result. Let's again go to the supply curve and drop the price. As the prices are dropping and as it hits the price floor, it cannot fall much further because it is a binding constraint. It is a legal binding. So when government imposes a price floor above the equilibrium price and equilibrium price is below the floor, the price floor is a binding constraint on the market. The forces of supply and demand tends to move the price towards the equilibrium price. But when market price hits the floor, it can fall no further. The market price is equal to the price. At this floor, quantity supply is greater than quantity demanded. This binding price floor causes a surplus. Thus, this policy was supposed to help the sellers, but at going prices, they are unable to do so. The second method of government policies are the government taxes. All governments impose taxes on goods and services to raise revenue, which is used for public purposes and public welfare. A tax on a good will affect quantity sold, and therefore we call it market shrinks, as well as both the price paid by buyers and the price received by sellers. Therefore, both buyers and seller share the burden of tax. Buyers pay more, sellers receive less. Let's analyze the tax incidence by applying the tool of supply and demand and following the 3 steps of analysis. When a tax is levied on buyers, the demand curve shifts to the left from D to D1. The equilibrium quantity falls from Q to Q1, and therefore we call market shrinks. The price that sellers receive from P to PS. The price the buyers pay inclusive of the tax rises from P to PB. Even though the tax is levied on buyers, buyers and seller share the burden of the tax. Buyers pay more and sellers receive less. When a tax is levied on sellers, the supply curve shifts to the left. The equilibrium quantity falls, therefore market shrinks from Q to Q1. The price that buyers pay rises from P to PB, and the price that sellers receive after paying the tax falls from P to PS. Even though the tax is levied on sellers, buyers and seller share the burden of the tax. Buyers pay more, sellers receive less. Subsidy is just the opposite of tax. It is an incentive or benefits to the key players in the market. In a subsidy, the market expands. Both buyers and sellers share the benefits. Buyers pay less and sellers receive more. If the tax is imposed on suppliers, the supply curve shifts up by the amount of the tax 50 cents to S2. The equilibrium quantity is Q2. The price paid by consumers is P2 and the price received after taxes are paid by the producer is P2 minus 50 cents. If the tax is imposed on consumers, the demand curve shifts down by the amount of tax 50 cents to D2. The downward shift in the demand curve when the tax is imposed on consumers is exactly the same magnitude as the upward shift in the supply curve when the tax is imposed on producers. So again, the equilibrium quantity is Q2, the price paid by consumers is P2, including the tax paid to the government, and the price received by producers is P2 minus 50 cents. The final impact is exactly the same because the buyer and seller will be sharing the burden of tax. As such, the government can impose tax on the either of the two, since the effect in terms of price and quantity of petrol after the tax will be the same. The more elastic the curves, the more effective this tax will be in reducing the quantity of petrol consumed. Greater elasticity means that quantity falls more in response to the rise in the price of petrol. The same tax wedge between demand and supply gives a much lower equilibrium quantity Q1 associated with the more elastic demand curve D1 than the equilibrium quantity Q2 associated with the more inelastic demand curve D2. The effect of the $5 subsidy on sellers is to shift the supply curve from S1 to S2. The new equilibrium quantity in the market will be Q2. The price that buyers pay will be P3 and the price that sellers receive is P2 is equal to P3 plus $5. The effect of the same $5 subsidy on buyers is to shift the demand curve for gym visits from D1 to D2. the new equilibrium quantity in the market will be Q2. The price that buyers pay will be P3, and the price that sellers will receive is P2 is equal to P3 plus $5. Hence, there is no difference to the prices and the quantities in this market whether the subsidy is paid to the buyer or the seller.